All right, my name is Jason Bible. We are here with the Texas Real Estate Mastermind, and tonight for Red Talk, we are going to talk about mortgages. But first, we're going to bring up Mohsen with the Texas Property Management Company to talk about the things that they do to manage our property.
Hello, my name is Mohsen. I'm one of the partners at the Texas Property Management Company. We manage about 170 homes in the greater Houston area. We have a 3-tier pricing, depending on which kind of property you have. We have an office downstairs. We are one of the few management companies that will work with Section 8. So if you guys want to take Section 8, we can help you out. And one of the things that sets us apart from some other PM companies is that we'll answer the phone. We have an office, so you can always get a hold of us. You can find us at thetexaspropertymanagementcompany.com.
Excellent. Thank you, sir. Their unofficial motto is, we answer the phone. Not even kidding. That's actually the unofficial motto. We answer the phone. So, all right. Thanks for watching, guys. I thank everybody that came out tonight. We're going to talk about mortgages, and I'm going to have our guests introduce themselves, and we'll start with Jennifer. What do you do, and where are you from?
Yeah, native Houstonian, Houston, Texas. I've been in the mortgage business as a loan officer for 27 years, almost 28. So 1995 I got in, and I just haven't left since. So I've been building a 100% referral business for that long. 70% of my business is realtors, so it's kind of a big community. I have my ear on the street always about those kinds of things. Primarily, I'd say the bulk of my business is helping people in conventional FHA loans, which is usually primary residence, but we also do about 10 to 15% investors, helped a lot of investors, thanks to this group, actually. Jason's been instrumental in that, but mostly conventional. I mean, that's my wheelhouse. Yeah. I can do some other stuff, but I like conventional. Yeah. So, yeah.
Excellent. I'm Wade Comeaux with Catalyst Funding. We are a real estate lender that focuses in the real estate investment space. So I've been in the mortgage industry just a little bit shorter than you, but I started an internship in 1996. Cool. So I've been in the space ever since. We started Catalyst Funding back in 2014. And we try to be a one-stop shop for real estate investors. So we provide private or hard money lending, as well as a wide variety of permanent financing, including both conventional and non-qualified mortgages. And with one loan officer, one credit pool, we can put you into pretty much any product you'd need in a single-family 1 to 4 space, as well as small multifamily.
Okay, great. All right, so right now in the industry, it kind of depends on when you're watching this video, but the dust up right now is the change in loan pricing. And I wonder if you guys could take a little bit, I don't know who wants to take the first question. I'm sure I want comments from both of you guys, because I definitely want to. So this is what we're hearing there. What we're hearing out on the street is you are going to be a borrower who has a higher credit score. I believe it starts at 720 or 780, where they will be penalized and essentially are subsidizing the risk for, let's say, a higher risk borrower. So maybe one of you guys could start and tell us what's going on there.
Yeah, so I always like to explain the why so that people understand. So I'll start there, and then I'll let you explain the heat grid. How about that?
That sounds good.
So rewind as to how this came out. So Fannie Mae and Freddie Mac are government-sponsored entities. So they're not owned by the government. I mean, they're for-profit companies, but I can tell you that behind the scenes, they operate at the mercy of the government. So if you rewind back to 2001, there was a memo that came out way back then that said, hey, Fannie and Freddie, you want to keep getting tax breaks? Guess what? You just have to make 70% of your portfolio low to moderate income. Wow. You got it. So then if you fast forward to 2008, that's how that all turned out, okay? Yeah. Because that's when we saw Fast and Easy and all that stuff. Mm-hmm. So now history's kind of repeating itself. I'm a little scared. Mm-hmm. But now what's happened is the same the same people, the government, have said to Fannie and Freddie, hey, you want to keep getting those tax cuts? All you got to do, hey, it's real simple. All you got to do is figure out a way to make sure that home ownership is possible for the underserved community. And the underserved community is usually people that have lower credit scores, right? So Federal Housing Finance Agency, which they're really over the conventional arm, they got together, the guys in the boardroom, I'm assuming, and they came up with a plan that they thought would accomplish the directive that they've been given. And so they came up with this, I call it the heat map, but I'm going to let Wade talk about it as far as who it affects, and then we can talk about how to navigate around it. There are ways to navigate around it. But if you want to talk about the grid, we can go from there.
Yeah, I'm not sure exactly what you mean by the grid, but
it's a color map.
I will give a few thoughts. I'll let you cover. I'll let you cover the grid itself. But at the end of the day, I mean, I believe in the objective of trying to help more people own homes. Right? I think that there's something admirable about that. I think the average American retires with about $250,000 in net worth, and most of that is in his or her primary residence. Right? So that's a very admirable thing. I think the way they're going about it, there are different opinions on that. Basically, for the person who has a higher credit rating and maybe more money to put down, they're going to pay about an extra $10 a month for every $100,000 is basically what I think the numbers are coming out to, from what I understand. I'm sorry, $100 a month for every $100,000. And then on the other side of the spectrum, the lower qualified borrowers who have lower FICO scores and less money to put down, it's going to be the inverse. So it's truly a subsidy going from one side to the other. And, hopefully it accomplishes goals that are important, but at the end of the day, most of the pricing is usually based on risk. And so this is definitely shifting it, and you're going to have more people who qualify for loans now that are riskier, and there could be implications to the overall economy and the housing market, because that is in large part, like you said, what led to some of the challenges in the great financial crisis back in 07, 08, and 09.
So on these particular borrowers, are they using it to buy mortgage insurance? I mean, what are the GSEs really doing? Is that what they're just putting in, or they're just making somebody else's mortgage cheaper? Maybe that's a better question to
So
ask.
what's happening is, and so I'll send you the grid so you can send it out, but if any of you follow Rob Krishman, okay, he's a good mortgage blog writer, and he's got a great, it's a whole grid that he did, and he put colors on it, so that's why I call it the heat map. So basically, the people that it's affecting the most are 720 to 759 credit, and 15 to 20% down, because those borrowers are perceived by whoever made these directives, are perceived to have the ability to save, so they might not notice it as much, I guess. So that when they're charged more, so for those people, there's about 125 basis point hit, which is usually about 0.3% to the pricing. So LLPA stands for loan level pricing adjustment. So if you're a conventional loan, it's conventional only. If you're in that mix of that grid and you're be like, oh, I'm so excited, I've saved my 20% down, and you're between 720 and 759 credit score, you're going to have a higher rate. And then the green part of this grid, that part of the grid is red, okay? And then the green part of this grid is the very bottom corner, which is below 640 credit and 3% down. And it's you get
the most
this
risky with the least amount of skin in the,
that's right.
in the deal. Okay.
So then you get a 175 basis point betterment, which is about 0.5%. So it's interesting. You want to know what I really think?
Yeah. Oh, sure. Just know this is going out to the masses here.
So honestly, from being on the front lines, I mean, I've closed conventional loans for homeowners, primary residences for a long time. And those borrowers that are below 640, y'all, they're not getting approved. They don't make it through the automated underwriting. So and even on paper, they can't get mortgage insurance. It's not in the guidelines. So this green part of the grid that's this 175 basis point betterment, it doesn't even apply. So Fannie Mae is going to have to totally rewrite their guidelines, which I haven't seen yet. So I'm like, okay, these borrowers up here in the middle that have the money to put down, more is being charged. So that money's coming into Fannie and Freddie, and the thought is that they're going to redistribute those funds by giving to those people in the lower part of the grid, giving them subsidies.
Right.
Okay? But there's a bottleneck because they're not going to be putting out as many subsidies as they're taking in because those people in that part of the grid aren't even qualifying for the loans anyway. So that's where I have an issue.
They're going to adjust the automated
the guidelines
platform.
They have to because and it hasn't come out yet.
It hasn't yet,
but that's got to happen because it's not going to help who it's intended to help.
Yeah. I read a stat when I was getting ready for our big event in February, and since rates began their increase, they said their average borrower had something like a 760 credit score. So when I saw this, this is for these borrowers at 600 or 700 and below, I'm like, where are those people? Yeah. Because we haven't been lending money to them since 2008. So I thought it was kind of interesting. It's like, there's just not a lot of, and like you said, I mean, they probably don't make enough, which is probably one of the reasons why, or they got too much debt and they've got all those other issues, and credit score is just a result of those other things. So can they qualify for a mortgage anyway?
I think that is where the rubber meets the road, is that they're trying to help people who would not qualify for mortgages before qualify now, both from a debt to income ratio perspective, but they think this may help, and then also from just an initial qualification perspective. But the reality is that, that particular area does not perform extremely well. And so I don't know if a lower payment is going to help them pay their bills that much better, but optimistically, it'll help more people get into homes, and hopefully they can make those payments. That's the hope.
I mean, I definitely believe that the underserved community, or I don't want to say underserved, because this has nothing to do with income. This has everything to do with credit score. So what's happening, though, is it really going to reach the targeted amount of people? Because the ones that are having trouble paying the mortgages and qualifying for a certain amount of house is people with lower income. Not necessarily bad credit. I mean, I've got clients that have lots of income and they have bad credit.
Sure. And you have the inverse as well, right? You have people that don't have great income that have good credit.
Is this really the solution? I mean, is there another way that we could be doing this? Because I don't know if all income levels are going to be affected by this. All income. So if, let's say I'm a teacher and I'm a single mama, which I have a lot of those, and I've been busting my butt to make sure that my credit is pristine, perfect, and 720 to 759 is not perfect, by the way.
Yeah.
So it's really hurting this middle America that's really trying to really advance their score and get up there. And then it's like, really, I got to be hit with this? So I don't know. I'm of course going to execute the plan, but what I do, there is a way around it. If you have a 780, you're really unaffected. There are loan level price adjustments for that, but mostly lenders were taking the hit because, we're the ones that are charged. We're the ones that are charged by Fannie when we sell them the loan. And of course, we're not going to take a 175 basis point hit and just lay there.
Cash. Yeah.
We have to pass it on, right? But you can, instead of 20% down, if you do 25% down, it lessens the hit. And if you do 40% down, it completely erases. But to go from 20 to 40, that's pretty big.
Yeah, that's a lot. Yeah,
but if you're above 780, you're really pretty much, you're in the clear. But if you're in that 720 to 759, then, and this is on all property types, by the way. It's on investment, second homes, refis, purchases, anything conventional.
Oh, it is on all conventional. It's not just...
Yeah, everything.
Crazy. Okay,
so it's not just loan is a conventional loan.
Okay, so it's not just owner-occupied properties.
No. No. It's on all of them.
Interesting.
Primary, investment, refi, cash out refi, home equity, everything.
Wow. Interesting.
Yeah. So So you can put more down, or what we're doing and saying, hey, instead of 20% down, let's show you, and this wouldn't work for an investor, but let's put 5% down, and let's see if I just compare the rates. I say, hey, either stretch to 25 or put 5, and let's see what's better.
Yeah.
And so sometimes, you pay PMI for a little bit, and then 2 months from now, just pay it down below 80%, your PMI will go away. So, I mean, there are solutions, because we're trying to work our way. When you see this grid, you're going to love it, because you love that kind of stuff. You can kind of work your way around the grid to where it's not as much of a hit. But right smack in the middle is bright red, and that's where people are 15 to 20% down, and they're being charged the most.
It's middle America, writing the check. It's
That's
great.
right. That's right.
Working a long time to save the 15 to 20% for the average American. That's not an easy thing to do.
No, it's not.
So it leads me to can I say one other
Go
thing for y'all investors?
Yeah.
So FHA, because of this, is becoming the new queen of the universe. And so if you're an investor and let's say you're selling a property, I mean, normally you don't really want it. I mean, FHA has its downsides, right?
It's got its own quirks.
You can't sign the addendum to waive the appraisal, thing, and you can, maybe you get rotted wood, but most of y'all stuff you fix it up anyway. But let's say you don't, right? Let's say there's some deteriorator maintenance, some deferred maintenance, right? So FHA isn't ideal, or you got to wait till the 90th day to get under contract, right? So those kind of things. But if you get a buyer that's FHA, the stigma is, oh, that buyer must be running on fumes and they must not be able to afford it. So is this really a buyer that we want? Well, you got to kind of rethink that and talk to the lender. I've got people on FHA right now. They have a 760. And if you compare an FHA to a conventional with 3-5% down, FHA is better because of these pricing hits. And so, there are some people that we're trying to show FHA, and FHA is if you combine it with down payment assistance, their rate is way down here. That is like the best combo is DPA together with FHA. Their rate is lower, so they can afford more house.
So how does one qualify for an FHA? What's that FHA borrower look like?
They have to have above a 620. Well, they really have to have above 600, but we prefer like 640. It's better. Because there's hits, there's hits.
Oh, yeah.
So, in the 600s usually, but you can have a credit score of, you can have a perfect credit score is fine, and your pricing, everything is still the same. But the beauty of FHA is it allows people to have up to a 55% debt to income ratio now. Think about that for a minute. Out of every dollar that you earn, 55% goes to debt.
Yeah.
Like, it's crazy, right?
And that's just your...
Yeah,
for your primary residence, right? Yeah,
for primary. Yeah, or if you're buying a multifamily and you're living in one of the units. But so FHA can really help a lot of people expand their price range that they normally wouldn't be able to buy right now. Mixed in with all this LLPA pricing thing, you just got to really weigh it. So just really be sure that if you're worried, if you're a seller and you're selling one of your properties and you're worried about maybe not passing FHA appraisal because of some deferred maintenance or the appraisal thing. I mean, usually investors are really good about, they know the market and they're they're going to price it right to sell it. You're not like a greedy homeowner seller, right? So don't discount. I guess my call to action is not to discount a buyer just because they're FHA and you think they're running on fumes. That's not necessarily the case. It just might be the best financial package for them. I
always thought FHA was for that first-time home buyer when you don't have that mortgage.
No.
I think I don't have a mortgage in my name, so would that make me an FHA client, maybe better, or borrower?
It doesn't mean if you don't have anything in your name. It just really matters where you have your primary. I mean, if you're going to occupy it as your primary, then you can buy a primary residence. If you're renting now, then so you don't have any. You're renting?
No, I'm living in one of my Airbnbs while I'm fixing up my house.
Gotcha.
But I'm thinking about buying another one, but I don't have a note on it, so I'm like, maybe I'll just go buy a place in the Heights, go back to the Heights, and put. That's why I'm watching the retail space so close.
Yeah, for sure.
I'm like, where can you?
No, it makes sense, and FHA, you don't have to be a first-time buyer. That's another beauty of it. But I mean, FHA has a lot of perks. I mean, you can even be putting 50% down, and the downside of FHA is you got to pay the mortgage insurance no matter how much you put down. But like, if you've been you can do an FHA loan in the middle of a bankruptcy as long as you get permission from the court. I'm just telling you, FHA is the greatest thing since Wonder Bread. Yeah.
Okay. All right. So we've gone over all the new loan pricing. Wade, I'm going to go to you to talk about rental properties and how we finance them. You know, when I started in this business in 2013, there was no non-QM. It was, if you're going out, you're going to do a traditional mortgage. You're going to do a traditional mortgage for an investor. You can have 10 in your name. It was very like, that was really and local banks, local regional banks would finance you too. But you have to build a relationship, and everybody's a little different. Well, now in the last 5, 6, 7 years, there's this whole non-QM out there. Yeah. Everyone calls it hedge fund money. Like there's this golden palace somewhere of money that comes down from Wall Street. But maybe you can talk a little bit about kind of the traditional financing for single-family rental properties and what's kind of going on in that non-QM space.
That's a great question, and I'll say some of the government decisions have really impacted this in the non-owner occupied conventional space as well. There has been reductions, and you know, there was a time whenever you were allowed to deliver 17% of your overall mortgages to Fannie, Freddie. In Fannie in particular, 17% could be non-owner occupied or investment. They took that down to 5%.
And that happened
That was last year.
Last year, right? Okay. Right. I remember that came out, and everyone's kind of like, I was like, uh-oh.
No, they've adjusted that some, but at the end of the day, the overall tenor is that both in how they impact, you know, the discussion we had earlier about the loan level price adjustments, and also in how they've impacted deliveries of non-owner occupied properties. There's a move to just finance more people as primary residents and to help, you know, the disenfranchised. So non-QM has really filled a gap there. And there was a time whenever the pricing gap was far more significant than it is today. Loan level price adjustments on non-owner occupied at like 75%, it's a 2.275 adjustment. If you get to 80%, it's like 4 1/8. Like these are really big adjustments. And because of the inverted yield curve, there's also a lot of discount points on almost every one of these non-owner occupied deals. So if you compare them to the DSCR product, the gap's not as big as it used to be. I would say, you know, maybe there's at the moment, maybe a 1% gap in interest rate, maybe less with some lenders, and then you might have a few points different in the non-QM loans. But at the end of the day, the non-qualified mortgage, it's the biggest difference is that you don't have to provide full income docs, and that there's an unlimited availability of it, right? You can also do blanket loans, like if you're an investor that owns 20, 30, 40 properties, you can put them all into one transaction.
Oh, wow.
Which is really attractive.
Awesome.
Yeah, it's very convenient for an investor. But in addition to that, in 90 days, you can do a refinance of that hard money loan if that's how you acquire the property, just like you can. You can do a little bit quicker, of course, on a conventional loan, but that ability to do it very quickly is a relatively newer thing. But at the end of the day, the non-QM space is excellent. If you work with a lender like us, you know, we can steer people into the best product for them individually, but the best price is still going to be conventional, but the gap is far smaller. And it's a very inclusive space in non-QM. Like the reserve requirements are very low, and the pricing is relatively attractive. The LTVs, 75, 80%, depending on the lender. So it's a very good product for an investor.
So there's a question. There's no prepayment penalty on, like, let's say I'm going to do a DSCR loan. What's my, like, I have to put what, 20% down, or is it 25?
Well, most of the people refinance a hard money loan. So it's not really out of pocket on the average transaction that we're seeing right now between the hard money loan and the permanent financing loan on a $300,000 property, all in. They're probably out of pocket $25 to $30K on both transactions. I think that's a very common number at the moment. So there's not a tremendous amount of people who buy that property because they're looking for the distressed property, right? So they're looking to either buy it for cash, fix it up themselves, and then refinance, or they're going to use a hard money loan and then use someone like our money to fix it up and then refi. So they're not a ton of straight purchases. But at the end of the day, you can get into those deals for, you know, even the Airbnb, you might be able to get into them for maybe $50K or something like that. So
that's cool.
Very attractive.
Yeah, the definitely bigger, because, you know, you're a little bit more out of pocket on the bigger ones. So, well, let's go back, kind of talk about for the new investor. We start with, we're going out, we find this giant piece of junk, and it's scary. You walk in, It's hot.
Yeah.
It smells like cats. Like, it's just awful, right? And you got to buy this thing. You don't want to use your own cash, so you're going to go to you guys. You got a hard money loan. We're going to get a hard money loan. So we'll have an appraisal. We're doing a survey. Got to do inspection. Of course, the inspection is going to be awful. Even on a brand new house, you get this inspection back sometimes. You're like, you got to be kidding me. Anyway, so we're going to use some hard money, buy the house, and then take me through that process of we've closed, we're using your money to purchase a property and renovate it, and kind of walk me through what that process looks like.
Sure. The most important difference is that the appraisal is going to be a subject to repairs appraisal. So in traditional land, it's just imperative that you get the contract over to your loan officer. Mm-hmm. That's whenever the ball can really start moving. Conversely, in this, you have to get the contract and you have to get the repair budget over, because you can't order the appraisal until you know exactly what's going to happen. Because the subject to appraisal means that the appraiser is going to look at the property not only as it sits, but he's going to look at the repair budget and project what the home is going to look like and find comparables that will allow you to determine the value after those repairs are done. So that's a very pivotal thing. And I will give the advice of any new investor, make sure that you have that dialed in, because if you change it after the fact, it changes your value. It's not something you can do. So you have to make sure that your repair budget is really dialed in. So once you get that dialed in, the typical hard money lender can close in about 7 days. So it's a much quicker process. Wow. The hard money appraisers understand that they need to move a lot quicker because these are distressed deals, right? Mm-hmm. You can't, sometimes it's facing a foreclosure or some other, the home might be damaged and the seller's selling at a discount because they want to sell it fast. Mm-hmm. They can't take 45 days. Mm-hmm. So whenever you go to the closing table, you often have to bring some money to close, but we're seeing a lot of deals right now that are better. We talked about this statistic the other day. I'll just brief caveat from the process. Before rates went up, the average discount that investors that had borrowed from us were seeing was about 10% on a $300,000 and below deal, $350 and below deal. Right now, that discount is 27.5%. Mm-hmm. So despite the fact the rates are higher and cash flows are a little bit lower, the equity capture is tremendous right now. It's really, really good. So it's a great time to be in the game. So anyway, whenever you know what you're going to be bringing to close, you have to, of course, bring a cashier's check or wire the money to close. Then after that, the big thing is the draw schedule, right? In almost every transaction, a contractor is going to require you to give them some money to kick off the job. Mm-hmm. The hard money lender does not do that. You're going to give them it's normally a third or 25%. So if it's a $30,000 job, you're going to need to give that person $10,000. And then you are reimbursed by the hard money lender. And the good news is you kind of use the hard money lender as the bad cop. Like most contractors, they have their guys, they're getting paid $150 a day, and they're just going to come to you and say, hey, I got to pay my guys this much money. It's the end of the week. But if they haven't done the work, can't pay them. And we will not. The hard money lender will not pay you. So you can use us as the bad cop there. But it's a draw process. You go through that draw process. If you're looking to flip, then you'll be working with an agent to get it on the market as soon as possible. If you're looking to do a buy and hold and you work with someone like us, we'll be working on the refinance simultaneously with the rehab. So we're helping you, with the draws, and we're very prepared as soon as you complete that rehab to get it refinanced into either the non-qualified, no income doc loan or the conventional loan.
Okay. That's one of the things I like that you guys do, because some of the lenders don't do that. And they wait until it's done, the appraisal's in, there's a tenant in there, and then it's like, now you start the refi process and you're in that hard money loan for another 30 days. And it's like, no, you want to, as soon as that thing's done and it can appraise, bang, you want to refinance it and then move on to the next one.
Yeah. That's good. Good.
All right. Well, what interest rates are you guys seeing? I know they're going to be a little bit different. 5 minutes from now, they could double. Well, I don't think that's going to happen anymore. Enough banks are getting smoked. So what are you guys seeing as interest rates for rental properties on hard money, non-QM, QM, and then on the owner-occupied, house they're going to live in?
I'll cover the investor stuff first. Most people in the hard money space raise their money either from wealthy individuals or mostly from commercial banks. So as prime rate increases, we see increasing price pressure as well. So I would say our rates right now are somewhere from about a 9.99 up to potentially 14%. Somewhere between 2 and 4 points would probably be about the average. We do have some introductory programs for people that are doing buy and hold that can be a little bit more attractive. And that's if you do want to identify with your loan officer what your exit strategy is so you can make sure you're getting into the best product. For non-qualified mortgages, I think the rates are typically in the mid to upper 6s to low 7s at the moment.
Oh,
Probably
wow.
somewhere from 2 to 3 points.
Yeah.
And then we do have one product that's very exciting. You were mentioning the prepayment penalty earlier. We do have one where you can buy it down to a 1-year prepay with only a quarter, which is
Really?
I'm really shocked.
That's
I'd buy that
huge.
deal in a heartbeat.
That's awesome.
Unbelievable. Like that is fantastic.
Because you will be refining in a year. Right?
Absolutely.
Yeah.
A year or shortly thereafter. But still, most of the prepays are normally like a 5, 4, 3, 2, 1, right? So that's a very attractive
Nice.
thing. And then in the conforming space, we did recently have some price adjustments. So we're going to see rates that are, hopefully somewhere in the mid, maybe in the slightly below that 6s. Sometimes we can get into that range. And then, no points on that, or maybe a discount point or so to get down to that point.
Okay.
That's on your conforming stuff.
Yeah.
Okay, cool. Yeah, because my conforming stuff, by the time you get the investor hits and all that, I mean, with no points, we're at 7.5, et cetera. So I'll just talk about the primary stuff.
Yeah.
But I mean, the primary stuff is in the mid to high 6s, just depending on your credit score, your LTV. I mean,
Yeah.
and it's hard to say with this new grid. I mean, we're pricing stuff out as quick as we can with new this, then that. There's just no straight and narrow answer anymore because it depends where on the grid you are now. FHA is similar. It's in the mid 6s. Pricing is really difficult because they all know when we're pricing in margins, I mean, lenders know they're going to get paid off in a couple years. So,
They got to make their money. I think a lot of folks don't know that.
Yeah.
You don't make money on notes constantly having to refinance them, right?
I
That's
mean-
not the actual whoever buys that note. It just doesn't work for them. So yeah, the pricing is kind of accordingly because I think everybody knows rates are coming down at least in the next couple of years, right?
Yeah. Yeah, most
Yeah.
of those things, keep in mind that I was quoting, that's with a reasonable amount of discount points because it's very difficult to get a par rate.
Oh, with discount, yeah. Okay, I was going
Very
to say, I
difficult
was
to
like,
get a
wow,
par.
no,
It's very difficult to get a
no
par rate
points?
in the non-owner occupied space. Yes.
Yeah, because I'm, my investor stuff on conventional is your best pricings with 25% equity. I mean, you can do
100%.
20%, but you are hosed. I mean, that's like 4 or 5 points.
I'm not quoting any 80% in there. That's like
Okay,
75%.
yeah, 75%.
With multiple discount points for sure.
75% for me yesterday or whatever was 75 LTV, 7.5 with 1 point. You got good credit, got 720 plus.
So on rates like that, how far out are they doing rate locks? Is that like, hey, here's your rate, we're closing tomorrow? Or is it?
We do 60. How about y'all?
We don't typically do 60. So we try to know whenever the borrower's coming out of that refi, of the rehab. We really don't want to lock in rates because people are optimistic. They think their contractor's going to get the deal done.
Yeah.
Oh,
And they're
Yeah.
going to get caught in that lock quandary of worst of
Yeah.
pricing. So we really try to lock whenever we know the property's about to be blue taped. And then if we're very confident that everything's dialed in, then we'll do like a 15-day lock at that point.
Yeah. That's
Which
good.
that's another reason that we can often get a little
Well,
bit more
and the rate's
attractive
better.
price, right?
I mean,
Yeah,
if I do
way
a
better.
60-day, it's an eighth of a percent more, like hands down. Your best rate is really the 15-day, but the 30, But yeah, when it's construction like that, yeah, you gotta.
You can't lock it in too early.
No.
We've seen that people really get into a bad spot.
It goes backwards. Yeah.
And loan to value, at least on the rental property, flips, all that sort of stuff, 70, 75, 80%, but more than likely, probably most of it's 75%.
On, some lenders do it a little bit differently. They look at flips and rentals. We just use a price point. So below 350 for most borrowers, we will only go to 75%. Anything above that, we're typically going 70. Getting to higher levels, it may even be 65 if it's a really big flip. Those are the areas where people can get squeezed in a market like this. So most of our savvy borrowers are not doing the really big flips at the moment. If they're doing flips, they're doing something where they have multiple exit strategies where if things do not go well and it's like a 9-month project, you don't know where we're going to be in 9 months, they can still put it into a DSCR loan or a non-QM or a conventional loan. And maybe they're not crushing it, but they're at least able to weather the storm.
Yeah.
Right.
We made a lot of phone calls this last week to a bunch of lenders, a bunch of folks in the real estate investment space here in Houston. And the theme we're hearing is the only investors that are flipping right now are the ones that have been doing it forever.
Yeah.
You're not seeing a lot of, hey, I do 1 or 2 a year and I've been doing this for 5 years. It's the real professional class, and most of those folks are staying away from the higher end properties. So I looked at Rob and I'm like, looks like I'm going back to the Heights and I'm gonna start buying, because if nobody's buying, I know where the values are going there over the next 5 or 6 years. And so it's interesting you mentioned that, because lenders obviously see it too. If it's a lot more risk, well, we're gonna bring the loan to value down a little bit, to kind of cover you. So
Sure.
Can you guys talk about, we talked a little about points and prepayment penalties. Can you guys talk a little about the fees in a typical loan? Wade, you can do the investor stuff, and then Jen, if you want to talk about just the kind of the retail stuff.
Yeah, on the non-QM, the fees are like a processing / underwriting fee, depending on the outlet that we use, somewhere between $1,250 and $1,750. If you're doing a blanket loan, then you can get the per property processing fee down, and underwriting fees down, which is attractive. On our hard money loans in all the major metros across Texas, we're at $999, and then you get into the rural areas and we have $1,250 or $1,500, depending on how small the area is. Not a lot of hard money lenders go into those areas. We only do it for our better borrowers, but we are more willing to go into the Corpus Christi's. I know you like to invest there, or the Golden Triangle, or Wichita Falls, or something like that. So if somebody's looking for those type of opportunities, we can be in those spaces, but we do have a little bit higher pricing and a little bit higher processing fee there.
Okay.
Mm-hmm. Yeah, we're just across the board, no matter which product. We're $1,800 processing, underwriting, the admin fees, appraisals. In addition to that, our appraisals are probably $625, $650. Mm-hmm. Plus, if it's an investment property, it's plus $125, just to add the rental schedule on there. Mm-hmm. That's probably, it sounds like it's pretty standard. I mean, $1,700 is probably an industry standard of what I see when I see competitor quotes.
On conventional loans, that's where we are too. Yeah. I was talking hard money is the $999, but we have the fees. Do we have a lot more points?
Yeah, a lot of points, yeah. And then points are, of course, on top of that.
Okay. Yeah. Pre-approvals. I get, we sell a lot of properties. We get pre-approvals from buyers. They send it to us, and it's, not even worth the paper it's written on, something they printed off the internet. So can you guys explain to me if one is looking for a lender, what should that pre-approval process look like?
So whenever I was flipping a lot more houses back in the day and I would get an offer, if that's what you're asking, what I would definitely want to see is that it's based on income, assets, right? Those are the things that I want to see. Like people could do it based on credit, and that doesn't mean anything to me. I want to know that. And then I would also personally speak with the loan officer that provided it, just make sure that was a solid deal, because one of the worst things that can happen is that property that you put on the market, you're never going to get a better price than you do whenever you first put it on the market. And then if something happens 45 days, even if it's the buyer that caused the problem, there's going to be a perception that something happened in the inspection, or whatever the case may be. So you really want that first deal to close. So I think if you are a flipper and you're selling that property and you get that offer letter over, and that pre-approval letter, you definitely want to have the income and assets reviewed, and I think have a conversation with the loan officer just to make sure they seem credible, they respond quickly, and they know what they're talking about.
Yeah, that's key.
Okay. So this is always an interesting question that nobody ever asks, but everybody wonders. What happens if I'm unable to make payments to the loan? And this is probably more of a hard money lender discussion, because traditional non-QM, they're going to send you all the nasty letters, then we're going to finally start the foreclosure process and all that. So let's say I'm in a hard money deal, construction ends up being too much, I don't have enough reserves, what's going to happen next?
Well, we are proud of our track record that we've only had 3 true foreclosures in our history, and we've done a lot of loans over the years.
3,
but normally, we work something out with the person. In reality, as long as the person's communicative, we can normally find another investor to take over that deal, unless the person has just really messed it up. In other words, they've they started working on the interior before they completed the foundation, something stupid like that. There are mistakes that you can make that make it very difficult to be able to get out of that deal at a reasonable level. But more often than not, we're going to try and work something out. That's our objective.
Okay.
We don't want to foreclose on people. There are some lenders out there that are kind of foreclosure mills. That's how they get their good deals for their own investment portfolio. That's not what we want to do. We really kind of keep that separate. We do sometimes present those deals to our investors, but at the end of the day, we want to have a workout. So the thing I would say that's most important is stay in communication and don't have false hope until you're at the point where you have no options. If you're seeing you're getting low on money, you really can't give money to the contractor anymore, you're feeling pressure to kind of BS your draw request with things that aren't really done, I think it's important to have an intelligent, honest communication with your lender. Just say, hey, I'm in a little bit of a spot. I just want to see what options do we have to try and work through this together. The worst thing you can do is just avoid conversations, have a couple of payments stack up, and then you're really in a bad spot.
Mm-hmm. Okay. Only 3. That's not bad. That's pretty. That's pretty good.
It's not that 3 people didn't mess up. We just found alternative solutions, right?
Yeah.
So that doesn't mean that there's only been 3 that the person did not get through it well. We just said, hey,
Let's be clear.
we're going to take this deal. You're going to give us $5K. We're going to place it with another person who has more cash to finish the job, right? Then that person doesn't have a foreclosure on their record.
Yeah.
It's not that only 3 people got in a bad spot. It's just we found a solution other than a permanent foreclosure, because we want that person to live to fight another day, right?
Right, yeah.
We want them to come back and maybe borrow from us again whenever they get their capital built back up.
Yeah, we our joke for the longest time is we were the private lender bailout team for Houston. We get a phone call from some investor, hey, I lent this guy $200,000 on my IRA, and I'm like, all right, well, are you guys still kind of cordial, or is it, no, we're just trying to figure out, is there something? Then we go out and look at it and go, all right, well, I can help you out, but we're going to have to do this and this and this. So, yeah, avoiding the problem never makes it better.
No.
Definitely doesn't ever make it better. Let's see, we got a ton of, what kind of timeline? We talked about hard money loans. Hard money loans, you can close as fast as 7 days, 2 weeks, that's sort of around there. On conventional and then non-QM, how long is that either purchase or refinance process taking these days?
So we have a very unique product in which we're basically able to do a final inspection at the end of the process, and it really shortens the time from the completion of the rehab until we're able to refinance. Often, from the time the rehab is complete on a conventional loan, we can complete that refinance within a week, which is really attractive. We have a very unique process for that. On the non-qualified mortgages, I would say from the time we get the appraisal, we can normally close in 15 days. Okay. So in our major metros, we have great relationships with appraisers. Because we do hard money loans, we have to get appraisals in 2 days all the time. We can get our conventional appraisals in comparable timeframes. So we have closed non-QM loans in 20, 25 days. That's not what we communicate as an expectation.
Right, yeah.
But I would say on average, it's 30 in the major metros, and then in rural areas, probably 45 is what I would say. And then on hard money, while it is 7 on average, there are times that we might sometimes we pick up deals from other lenders that can't get it closed. And if it's a well-qualified borrower, we can sometimes do some very unique things and close it even faster than that. So if there's somebody out there who's in a pickle and they have a lender who can't get it closed quick, you can always reach out and see if we can do it faster. That's in the major metros. Yeah. We can't do that in, Jasper, Texas or something
tough
like that.
in Corpus. Yeah, it's tough doing it that fast in Corpus. So, Jennifer, how long is that typically on the
No, it's similar. I mean, for me, 30 days is what I say to be comfortable. But like, if we have someone, we've had their docs, they did a good job at the pre-approval, docs are all in line, not too old, that we don't have to refresh a ton. We could do it in 3 weeks if we had to, but I like to say 30 just to,
30 is the right
sweet spot. It's a sweet spot.
It's a good little runway. I'll ask you guys one more question, and we'll open it up to the audience here and the folks online. So you work with a lot of borrowers. What are the, let's say, top 3 big mistakes that you see when you're reviewing, let's say, their personal financial statement, or Wade, maybe a real estate investor is doing a deal and something goes sideways? What are those kind of big 3 things that are big challenges for borrowers?
So we're going to talk hard money first.
Yeah, we can do hard money first.
I would definitely say that people early investors try to do too much on a deal. In other words, they're going to try and move walls. They're going to add bathrooms. They're going to add square footage. They see, television shows, and these people have been doing these things for 10 or 15 years. Like, they have a ton of experience. They have the right contractors. I think it's very good on your first deal, just find a nice paint and lipstick deal, right? You get in there, you make your contacts, you change flooring, you maybe paint cabinets, you change countertops. It's a deal that's down the fairway. You might not make a home run on it, but I think that's a good, safe deal for your first deal. we see a lot of people make mistakes because they don't understand load-bearing walls or just hidden things that until you screwed up once yourself or you've maybe been in the business, you're just not going to know about it. Another thing is that in hard money space, people put up a lot of money for non-refundable earnest money, right? Sometimes it's $2,500, sometimes $5,000. I see $10,000 sometimes. And you have to meet the close date. So you have to get the contract to us. You have to get especially the repair budget. And then you have to get all your docs in very quickly. And you can't expect, like if it's a 7-day close, you can't take 5 days to get us everything expected. And that happens sometimes.
Well, and you guys can't get an appraisal until they have what? The rehab budget.
Got to have the rehab.
Got to have the scope of work. And otherwise the appraiser's like, well, I don't know. What is this supposed to look like when you guys are done?
So that's key. If you want to not lose your earnest money and not piss off your wholesaler, and we certainly don't want to piss off the wholesalers because they're huge to our business. Like we want to make close dates, but you have to make sure that you're really getting that needs list in right away. If we need to close in 7 days, you need to look at it like I need to get this in 7 hours at minimum, right? I think you really have to have that approach. And then the last thing I would say is just have the game plan in mind. Don't let the deal dictate your game plan. Like come into the business with what you need to do based on your financial situation and what your goals are, right? I see people come in and say they just have a good deal that they find. That may be a better deal to wholesale if it's not right for you. Like if it's a $600,000 flip and you got $50K, like is that the right deal for you? Or can you maybe wholesale that deal and make a nice chunk and do a deal that's more in your wheelhouse? So I think having a good strategy and people like you in the masterminds can help people come up with that strategy. The biggest mistake is not every deal is good for everybody just because it's a good deal. You need to have either the experience, the money, the access to capital to do a deal that may be bigger outside of your wheelhouse. Or sometimes you're not ready for a buy and hold. You're really ready for a flip, but you don't have the wherewithal to hold a property because you just not ready. Yeah. So have a good strategy in place, I think.
Okay.
So on conventional, whether it's investment or primary, same. Good with, you said it, good with documents. Like you just got to be tight, guy. Like you just can't delay. If we ask you for something, just get on it because keep going to this side. Oh, now I'm going too much.
You're good.
Okay, just
you
stay
can
right
use
there.
me as a fulcrum to get around.
Just be prepared. And I know that docs are not everybody's love language, but just the faster you can comply with requests, and like we talked before about, just don't avoid the situation.
Sure.
Like just talk to us if you're having a time. I'd say that's one mistake that people make. The other is when you're doing your tax returns. I mean, if you're going to go for the conventional route and on the tax returns, don't write everything off. Just show some positive, and also pay your tax bill on time. Like find some other way to finance it because financing it with the IRS, we can't close. I don't know about y'all, but until we verify from the IRS what your payment plan is, we can't close.
Yeah.
And so just put it on a credit card or something. And then the other thing is reserves. So I think even whether you probably want reserves too,
Sure.
right?
That's in hard money, it's not necessarily reserves, but you have to have assets, right?
You got to have something. And equity in a property is not an asset because you can't get to it. So like whether it's a 401k or you got to have something. So the hardest time we have approving, at least in conventional, is when you've got everything in your properties and you have absolutely nothing to fall back on. Nothing. No IRA, no nothing. So, you got to have some backing.
We tell everybody starting out, I'm like, you need 50 to 100 grand in a checking account somewhere.
Yeah, somewhere, and don't touch it.
And don't touch. Yeah, it can be in your brokerage account. It can be wherever, but it's like they got to have that liquidity in case you got to get to it quick. So
I might add two more things real quick before we move on.
it.
You made a great point about how you file your tax returns, and just to make sure. Most people may not know this that have not been investing in real estate. To your point, if you expense everything, you get the benefit that year, but you crush your chance to qualify for a conventional loan.
That's right.
But if you just amortize or depreciate it, you still get those tax benefits. It's just stretched out over a period, and we can add all of that back.
Yeah.
So it totally changes the game. And what's really cool is if you do this right, if you can qualify for your primary residence, and you can qualify, after that, you can qualify for rentals as long as they cash flow.
Yeah.
We got to take, 25% vacancy rate, but you can buy 10 in your name. Yeah. You can buy 10 in your spouse's name if you don't have a primary, maybe 19. total between the two of you. You could do all of that if you have properties that cash flow with the 25% vacancy rate. So you just have to not file your taxes in a way in which you really hurt yourself.
Yeah, that's right.
Yeah, you do get the business owners that literally write everything off, and it's like you made nothing last year.
Yeah.
It's like
everything.
Had a friend of mine that he does really well. His W-2, he can't. How can I put this? He doesn't have the ability to go reinvest it. So we get a big payday, we just go and buy some more stuff with it. So he makes about $3 million a year and expenses like $4 million against his income. But it's like, so he was trying to buy a primary residence out in I think it was in West U, and every mortgage person he took it to, he's like, man, you got to redo these. Like this is
we
insane,
can't do this.
right? We can't do this. So all right, well, thanks so much, guys. Jason Bible, Texas Real Estate Mastermind, and we will see y'all next month.
Awesome.
Thanks, everybody. Thanks, Jason.
Yeah, you bet. Thanks.
Thank you.